With interest rates at nearly 8% or well over that, depending where you look, and home prices at nearly the highest ever, buying a home has never been more unaffordable. In fact, home affordability has reached the lowest levels in over 25 years, dating back to 1997. So if you're looking to become a homeowner, or maybe you want to move up, trade down, or you've probably wondered what are some of the things that you can do to make homeownership less expensive, I want you to watch this video because I want to show you some of the things that you can do to make homeownership a little bit more affordable, even with these crazy high prices and interest rates. Now, I want to break this down between two major components that make up buying a home in general, and that is the amount of money coming out of your pocket and also your monthly payments. Now, I'd like to tell you that you can keep both to a minimum, but unfortunately, that's very difficult to do in this housing market. I mean, there are some situations that you can make that happen, but for most of you, you won't be able to do so, and I'm going to explain that later. So let's go ahead and start with how to buy a home while keeping the most amount of money in your pocket. So right now, even if you have access to a large down payment, and for me, that's anything over 10%, I recommend my clients to do the lowest down payment possible that they can qualify for, and this is the reason why. So if you have really good credit score, you can get into a conventional loan with 3% down, and if you are a first-time home buyer, or a 5% down payment if you're not. Now, with a really good credit score, your mortgage insurance will still be very, very cheap. So for example, if your credit scores were above 740 on a $500,000 mortgage, you might just pay about $125 a month. Now, a lot of people hate even thinking about having to have PMI on their loan, but they simply don't understand the benefits of having it. Now, in this case, PMI allows you to get more leverage, safe leverage, very cheaply. Now, on that same note, so that you can see the payment difference, if you're buying a $500,000 home, putting down 20% will mean coming out of pocket with about $100,000 for the down payment alone. That's not counting closing costs. With a 7.87% interest rate, your payment will be about $3,370 a month. Now, consider doing a 5% down with an interest rate of 8.125. Your monthly payment will be about $3,760 a month. Adding $125 a month for PMI, your total monthly payment, not including taxes, insurance, will be about $3,885 a month. So really, your monthly payment will only be about $500 a month less if you were to put down 20%. Or a difference of $75,000. Now, you could do a heck of a lot more with that kind of money and not just dump it into one house only. I mean, hell, for example, you can go and buy probably even an investment property. Now, for those of you who don't have access to a lot of money, take advantage of low down payment programs and even down payment assistance. For example, FHA loans require a minimum 3.5% down payment, and in most areas, you can get a loan amount up to $525,000 for a single family home with FHA. Now, meanwhile, if you are a first-time home buyer, you can still do the 3% down payment conventional mortgage. New conventional loan limits have been raised for 2024, and in most areas around the country, the new loan limit for conventional loans is now $750,000, which means that you can buy a home up to $773,000 and put just 3% down. Now, another thing that I would like to look into if you are a first-time home buyer is down payment assistance. Now, down payment assistance is not something that I necessarily love or have loved in the past, as I believe that anyone looking to buy a home should have money to buy it in the first place. I mean, look, even to go and rent a property, you have to have some money for a security deposit and things of that nature. So why should buying a home be any cheaper? But anyways, I digress. Anyways, down payment assistance programs can help those who have the money or might not have any money, and obviously they need that assistance towards buying a home. So now most down payment assistance programs can provide anywhere between 3.5% to 5% of the purchase price. So for example, one really cool strategy that I've used with my clients is that we do a 5% down payment assistance program, and we kind of break it up into two parts. We use 3% for the down payment, and then we use the other 2% for closing costs. However, whether or not you're getting a down payment assistance program or you're bringing your own down payment, I actually encourage you and recommend you that you always get the seller to pay your closing costs, or at least a portion of them. Now, I understand that some markets that still might be a little bit difficult to do because those markets might be kind of hot. But trust me, the market has kind of slowed down considerably. Not many people can afford these higher interest rates, so competition has slowed down. So for example, I live in Atlanta, Georgia, and my company does most of our loans here in this area. And Atlanta is still considered one of the hottest markets in the country over the last few years. And I can tell you that 4 out of 5 of my home buyer clients are getting some sort of seller concession. Now, by the way, if you're getting a mortgage, it is almost always better to have the seller pay your closing costs rather than negotiate for a lower price. And this is kind of what I mean by that, because if you were buying, for example, a $600,000 home, your closing costs will be about 3% or $18,000. Now, if you get the seller to pay all your closing costs, you're essentially saving that amount of money right now in today's dollars right away, decreasing your cash to close. But a lot of people look at negotiating the price, and this is why I actually don't recommend doing that. Because if you were to get the seller to reduce the price by $18,000, now your home price will be $582,000. But if you were doing a loan for $552,000 with 5% down, your down payment will be $18,000. So you see why this is still better to pay full price for the house instead of getting the seller to lower the price. So when you can get the seller to pay for your closing costs, not only you can save on how much money you're gonna need out of pocket, but you can accomplish another thing. What if I were to tell you that you can get an interest rate similar to what was going on around last year, or even almost as low as what they were before COVID? Well, you can actually achieve this when you get the seller to pay for your closing cost. And this is by taking of the 2-1 buy down program or 3-2-1 buy down program. So the way this works is that the seller can give you a seller concession or a subsidy, if you will. And with it, your first year's interest rate is 2 percentage points lower than whatever the ongoing rate is of today. On the second year, the interest rate is 1 percentage points lower. So I'm gonna give you an example. If you were to get locked in today with a 7.5% interest rate for an FHA loan, your first year's interest rate will be 5.5%. And then the second year, it will be 6.5%. Then on the third year, that interest rate will default to today's interest rate of 7.5%. Now, obviously, by taking advantage of this program, you get to enjoy 2 years of lower payments that wouldn't be available with today's interest rates. Now, by the way, there are more than just the 2-1 buy down program. You can also do a 3-2-1 buy down, or you can also do a 1-0 buy down. Now, with the 3-2-1 buy down, the first year's interest rate will be 3 percentage points lower, 2 percentage points lower on the second year, and then finally 1 point lower on the third year. And the 1-0 buy down is the way it sounds. The first year is gonna be 1 percentage point lower. Now, one thing that I don't want you to get confused is that with these buy down programs, it's not the same thing as paying points or buying points. Because buying points is when you get to pay a certain amount of money up front in exchange for a lower interest rate. So for example, if you pay 1% of the loan amount, your rate will be roughly a 1/4 percentage points lower than that it would normally be. You will not be able to pay enough points to get an interest rate into the 5% rates with today's interest rates. It's basically impossible. The only way that you can accomplish this is with the buy down program. And the only way to accomplish the buy down program is with the seller giving you a seller concession. But it goes without saying that you could totally use seller concessions to buy points also. So for example, I had a client, a first-time home buyer a few days ago who did a 3% down. He was able to get all her closing costs paid by the seller, about $12,000, and we were able to get her a grant for $5,200, which she doesn't have to pay back. And we used it towards her down payment. Now, we used part of the seller concession to buy down her interest rate into the low 6% rates, and there was still money left over for some of her closing costs. Like all in all, it was a great mortgage deal for her. She was able to bring very little money out of her pocket for closing costs. She was able to get a grant, and she was able to get the seller to subsidize buying points. So it was definitely a good thing for her. Anyways, guys, hopefully these tips can help you. I appreciate you watching this video and consider subscribing. Thank you so much, and I'll see you until next time.